technical, but was it understandable?
Yes, it was understandable.
Do you still fear online?
We are there.
No, it is very good.
Okay. So let's now start. We can now all mute so that you can start.
Yes.
So we want to go to part 2 of our consolidation. I've divided consolidation into 3 parts. There is the consolidated income statement. There is the, actually I can divide it into 4 parts. Okay, let me just divide it into 3. There is the consolidated income statement. There is the consolidated balance sheet in general. There will be just an area on cost of investment. How do we calculate the cost of investment? But that one we want to concentrate on it tomorrow. How do we calculate cost of investment? Whenever you are purchasing a company, how do you buy? You can buy by cash, you can buy by share exchange, you can buy by loans, etc. So tomorrow's class will focus on cost of investment using the different ways of acquisition. If it's share exchange question, like in November 2021, November 2021, it was through share exchange. So we'll be looking at all that. So, but that is for tomorrow's class. So you should know what we are going to cover tomorrow. So keep time tomorrow also. So tomorrow we'll be looking at share exchange, deferred cash. Sometimes you buy a company, but you promise to pay them at a later stage. Please, let's mute.
What time?
Whenever you are in class, please mute. I always don't want to mute people permanently because I give a room for questions. But again, don't misuse the room for questions. Whenever you join, because if I go back, I'm wasting time. So I was talking about that. So that one will cover tomorrow, about cost of investment. It can be through immediate cash. You can invest by paying cash immediately. That is number 1. Number 2, you can invest by paying cash, but yes, you promise to pay after 1 year. That is called deferred consideration. So in that case, you'll have to convert future values into present values. By using that formula, we learned 1 divided by 1 plus r raised to power n. And then you can also acquire a company through share exchange, where you give the subsidiary some shares in your company. So that will be the concentration of tomorrow's class. Now, today's afternoon session, and we are remaining with around 1 hour 20 minutes, we want to introduce balance sheet. I want to make it 2-way. First of all, I'll start with a simple, especially for those doing it for the first time, and I've seen the numbers have really increased, which is good. So those doing it for the first time, we will see how do we consolidate a basic income, a basic balance sheet. And then once you have looked at that, we will now go back to that question we were doing in the morning. But now we do the second part, we do the balance sheet part of it, because it was a 30 marks question. So allow me now to start consolidated statement of financial position. This is based on an assumption that everyone knows how to prepare a balance sheet. Remember, a balance sheet has got non-current assets, current assets, equity, non-current liabilities, and current liabilities in that order. Non-current assets, current assets, equity, non-current liabilities, and current liabilities in that order. The slide 2 is just telling us what we are to cover. Now, whenever there is a question on consolidated statement of financial position, but let me use the word balance sheet because that is what many people know. Whenever there is a question on consolidated balance sheet, you should always check out on the following workings. Number 1, once you have accounted for all those additional informations we looked at in the morning, you must calculate what is called goodwill. You must calculate what is called consolidated retained earnings, and you must calculate what is called non-controlling interest. I will explain about loan notes later on, not now. So there are 3 items. Whenever you have a balance sheet question, you must, after you have accounted for all the workings in the additional information, the last 3 workings. So you see in the morning we had around, was it 6 additional informations? After those additional information, you will be forced to add these 3. Number 7 will be goodwill, number 8 will be consolidated retained earnings, and number 9 will be non-controlling interest. Now, we had already explained what goodwill was in our last class, physical class. Now, we said goodwill is the difference between purchase consideration. We said purchase consideration is also known as cost of investment. So goodwill is the difference between purchase consideration and net assets of the business being acquired. So you compare what you are paying for that company and the value of the net assets. The difference between what you are paying and the value of the net assets is known as what? Goodwill. And we also said in class, net assets is the same as what? Equity. Net assets, I gave out formulas to confirm they are the same. Net assets is the same as equity. So goodwill is the difference between purchase consideration, which is also known as cost of investment, and net assets, which is also called equity. And I stress here of subsidiary. Of sub is just enough to know that it's a subsidiary of the company you are acquiring. If it's an associate of the associate. So net assets have already explained here. Net assets is the value of the business being acquired. Net assets is normally equals to total assets minus total liabilities, or net assets is equal to equity. Okay. Now I've given an example of how to calculate, but I don't need to go into that. How to calculate net assets or how to get the equity. I'll come back to that later on. Types of goodwill. There are 2 types of goodwill. Goodwill can either be positive goodwill or it can be a negative goodwill. So when we talk of goodwill, goodwill can either be positive goodwill or it can be a negative goodwill. Let's start with positive goodwill. What is positive goodwill? Positive goodwill arises when whatever you have paid is more than the net assets. If what you have paid to acquire the company, that is the purchase consideration, or also known as cost of investment, is more than the net assets, in that case, we call it positive goodwill. Now, when you get a positive goodwill, the positive goodwill should be taken to the balance sheet as a non-current asset. So whenever you calculate the positive goodwill, if it's positive, take it to the balance sheet as a non-current asset. Positive balance sheet as a non-current asset. But before you take it there, if there is any impairment, deduct first the impairment. Deduct first any impairment if it is positive goodwill. Now, negative goodwill. Negative goodwill, on the other hand, arises when your net assets or equity is more than what you paid. When the net assets is more than what you paid, it is called what? Negative goodwill. Now, negative goodwill is not included in non-current assets. Negative goodwill is not included in non-current assets. Negative goodwill is treated as income. It is not non-current asset. Negative goodwill is treated as income. Negative goodwill is treated as income. I'm just trying to admit latecomers. Negative goodwill is treated as income, added when calculating consolidated retained earnings. I will explain that because we are about to look at that. Now, what is the format? There are, so let's have a note, NB. note, there are two formats. There are two methods used. Please take note of that. Used to calculate just a second, please, a second. If you have lost network, please, so that you don't interfere with class, just post in the chats. If you post, sorry, just post in the group. At least somebody who is in already in class can see the message in the group and unmute and inform me. Because, is that okay?
We didn't get it.
Pardon?
We didn't understand your request.
I'm saying if you lose network and you want to rejoin, and you find that, you know, when I get into teaching, into the spirit of teaching, sometimes I forget I should admit people. Just post in the group and then anybody who is in class will inform me and I allow you in. That is in case I forget. Is that okay?
Okay, thank you.
Yeah, that's okay.
Okay. So that I don't go back. Like now there is somebody who has called me that I was
amasegonda recording.
Okay, what was I explaining before that? There are two methods used to calculate goodwill. There are two methods we can, what am I doing? Two methods used to calculate goodwill. Always read exams question carefully to know which method the examiner has asked you. So method one is called net assets method. And method two is called fair value method. So if you see the word fair value of non-controlling interest, so used when fair value of non-controlling interest is provided. So I hope I'm very clear there. The method two is only used when the fair value of non-controlling interest is provided. It's normally the most common unit. The examiner wants to know if you can use the fair value or not. So when do we use method two? Used when the fair value of non-controlling interest is provided. If the fair value of non-controlling interest is not provided, it is impossible to use the second method. So how do we calculate goodwill? So format of goodwill, I'll start with format of goodwill, and I'm in method one. I hope I'm clear. There are two methods. Method one. So what you'll need is two columns. There will be a column that you post. So you start with purchase consideration. Purchase consideration is what you pay to acquire a company. You post it there. And then you come and list the net assets. Net assets is the same as equity of the subsidiary. When you are rushing in exams, sometimes you end up picking the equity of the parent. You pick the net assets of the subsidiary. Now, net assets is the same as equity. So which means you will pick the ordinary share capital, share premium, revaluation reserves,
Please, sorry, come up again on the format of goodwill.
This is the format we are talking of. There are two ways of calculating goodwill. The first way is called net assets method. I've called it method one. It is not called method 1. I'm the one who has called it method 1. The second method of calculating goodwill is called fair value method. I have called it what? Method 2. It is not called method 2. Now, I'm saying the fair value method is only used if the question provides you with fair value of non-controlling interest. So if the question does not provide you with fair value of non-controlling interest, you know you should use method 1. Is it clear?
Yes.
Okay, fine. Let's continue. Now we are saying that I'm starting with method 1. Method 1 is which method? Net assets method. So in method 1, you list your purchase consideration or cost of investment, XX. And then after that, you come and list your equity of subsidiary. Equity of subsidiary. What is the equity of the ordinary share capital, share premium, revaluation reserve, retained earnings? But the retained earnings you use is which retained earnings? You use the retained earnings, which is retained earnings at the day you acquired the company. Because goodwill is calculated at the date of acquisition. So the retained earnings you use is what we call pre-acquisition retained earnings. Pre-acquisition retained earnings, it becomes your retained earnings on the date of acquisition. How much profits did this company have at the time we were buying them? That is pre-acquisition. And then you get the total of your equity. You get the total of your equity. Once you've gotten the total of your equity, remember this is equity of the whole subsidiary, but you did not acquire the whole subsidiary. Maybe you acquired only 80%. You now get 80% of the total equity you acquired. This one here. Percentage of this. If you acquired 80%, 80% of your total equity. If you acquired 90%, 90% of your total equity, and you bring the answer there. And then now you take purchase consideration minus the percentage of your total equity. The answer you get is the goodwill. If you get a positive answer, it is positive goodwill. It goes to balance sheet as a non-current asset. If you get a negative answer, it is a negative goodwill. It goes to the income statement as part of retained earnings, or it's treated as income in the retained earnings in the income statement. That is format 1. Not format 1, we only have purchase consideration and net assets, and then we get a percentage of net assets. Format 2. Format?
Sorry, sir.
Yes.
There is someone want to join.
Excuse sir, please can you come again on the how you can press the goodwill after calculating it in the balance sheet or income statement?
Pardon, repeat the question as I wait for the person to join.
Yes. Can you come back or come again for the placement of goodwill after calculating it in the how you can press the goodwill after calculating it in income statement?
I've got a new. I'll explain. Just a second. Somebody's waiting and I'm not seeing them.
Yes.
Okay, is when they are coming. Frank. Okay, let's continue. What I'm saying is, once you get the goodwill,
yes,
if the answer here is positive, you take it to the balance sheet as an non-current asset. You take it to the balance sheet as an non-current asset. Balance sheet as an non-current asset because it is positive. The answer is positive. It is known as positive goodwill. If the answer is negative, you take it to the income statement. You take it to the income statement. as you take it as income in the year that it arose. But remember, at the end of the day, the income statement final answer will still go to the balance sheet. I hope you know that. The final answer of the income statement at the end of the day will go to the balance sheet as part of equity, but I will come to that slowly. So what I've said, if positive, balance sheet as an non-current asset. If negative, income statement as income. So this is method 1. Method 2. So let's call this method 2. Method 2, we said it's also called fair value method. Method 2 is used.
Sir.
Yes.
I have a retro question on the treatment of negative goodwill in
Yes.
income statement. So it come as other income after gross profit, or it come on the other side of other comprehensive income?
You will see how we treat it. There will be an example. It goes to consolidated retained earnings. It goes to consolidated retained earnings.
Okay.
In other words, it comes as other incomes. As other incomes. Is that okay?
Okay.
Yes. It comes as other incomes. Okay, let's go to method 2. Method 2 now, we are trying to look at method 2. Now, there is a purchase consideration, and then you come and add fair value. That is why it's called fair value method. Fair value of non-controlling interest. I know in the notes I made a mistake and wrote these as non-current assets. So if you are checking the notes, is it? I think I made a mistake in the note. Let me just see if I had corrected it or not. Thank you. Let me see if I had corrected it. Please, let's mute. Yes, this one. It's supposed to be non-controlling interest. Please correct it in your notes if you have the notes. It's not non-current asset. It's non-controlling interest. So everything I'm teaching is already in the notes. This one, non-controlling interest. Okay, let's go back. I remember that I made a mistake when I was typing. So you add fair value of non-controlling interest to your purchase consideration. So what is the difference between method 1 and method 2? The difference is this. The difference is that. That is the difference between method 1 and method 2. And then the same way you picked the equity, you also pick the equity of the subsidiary. Everything the same. But here, you realize that the whole equity is transferred here. Don't get percentage. In method 2, you don't get, in method 1, you see method 1, we took the percentage of the total net assets, is what we brought here. But in method 2, you assume it is 100%. The whole 100% is what you transfer here. Why do we do that? The 100% is both the amount of the parent and the non-controlling interest. This one, because we added non-controlling interest here, it makes this and that 100%. Because this accounts for non-controlling interest. Because we added fair value of non-controlling interest. Because the fair value of non-controlling interest is there, and then there is the what you paid for, maybe 80%. If you add non-controlling interest plus what you paid, it becomes 100%. So when you're using this method 2, these you use it as 100%. The total net assets is assumed is 100%, and that is what you subtract from this total. Have we understood the difference between method 1 and method 2? Method 1 does not have fair value of non-controlling interest. Method 1 assumes the net assets are 100. Sorry, method 1, I'm explaining method 1. Method 1 does not have fair value of non-controlling interest. Method 1 uses this as a percentage. Method 2 has fair value of non-controlling interest. Method 2 uses this as 100%. And then you get the goodwill, which can either be positive or negative. I don't know if
Both method gives same answer.
yes, but
And which one is
information
preferred by
available
the family?
sometimes cannot allow you. I'm trying to mute somebody. Information available sometimes cannot allow you to use method 1 or method 2. It depends on the information available. What is the information available? If the fair value of non-controlling interest is provided or if it is not provided. That is goodwill. Number 2, don't worry, I'm going to look at an example. That's why we should minimize our questions until when I start doing examples. So when I start doing examples, you can ask the questions. So the second requirement is consolidated retained earnings. Always ensure you know how to calculate consolidated retained earnings. Now, under consolidated retained earnings, the format is below. You list the parent company. You have one column for the parent company, and you have another column for the subsidiary. You have one column for the parent, and you have another column for the subsidiary. So the first column becomes the parent, and the other one for the subsidiary. Now, you go to the balance sheet and pick the retained earnings in the balance sheet. You post the one for the parent. You also post the one for the subsidiary. What I'm saying is this. That question was in page, anybody with that page, there? It's good to show you what I'm doing. It was page 170, if I'm not wrong. Page 170. What I'm saying that you go to the balance sheet. I hope it was here. Yes. You go to the balance sheet and you can see here in the balance sheet, there is the equity, these two equities. There are those two equities in the balance sheet. That is what I mean by of the parent and of the subsidiary. Of the parent and of the subsidiary. So that is what you post here, of the parent and of the subsidiary. Now, if the question does not have any adjustments, adjustments means there is no sale between the parent and the subsidiary. There is no intercompany sales. Adjustment means there is no fair value adjustment. It means there is no property that was valued upwards or downwards. Adjustment means there is no sale. There is no sale of non-current assets between the parent and the subsidiary. If there are no adjustments, you come and remove pre-acquisition profit of the subsidiary. Please, David, follow rules. Okay, so adjustment means there are when there are no adjustments, you come and less pre-acquisition retained earnings. Why do we remove pre-acquisition retained earnings? Because that is profit that was made before we acquired the company. Profit that was made before we acquired the company. Now, if it was before we acquired the company, you take the total profit minus profit before we acquired the company. What you remain with is post. It is profit after we acquired the company. It is called post, the profit after. Now, in this profit after, you only pick the percentage acquired. If you acquired 80%, you only pick 80% of the post-acquisition profit. You only pick the percentage of the post-acquisition profit and you bring it here. You bring it in the first column. Because if you acquired, for example, 80% of the post profit, it is now the profit of the parent. It is the profit of the parent because the parent bought the subsidiary. You bring it in that column. If there is any negative goodwill, you remember the person who was asking me, negative goodwill, you add it there, if any. If there is any negative goodwill, you add it in that section. Now, this is a simple consolidated retained earnings. In other words, consolidated retained earnings without any adjustments. Let me prepare a new consolidated retained earnings with adjustments. So, retained earnings with adjustments. With adjustments, I want to show you how to account for adjustments. So, which means I'll have to remove these ones so that I go step by step. So, if there are adjustments, what do we do? Now, if there are adjustments, for example, if the subsidiary sells goods to the parent, who has made the profit? If subsidiary sells goods to the parent, who has made the profit?
It's subsidiary.
Subsidiary.
And if the goods have not been sold to the third party, it gives rise to unrealized profit. You less unrealized profit on goods, sale of goods. But you only less that if it is the subsidiary to the parent. You less it from there if it is subsidiary to the parent. I'll tell you where to less if it is the parent to the subsidiary. Why do we remove? Because this is a profit that was not made. Let me give you another adjustment. Remember, I'm talking of retained earnings with adjustments. Another adjustment. If the parent was buying the subsidiary and the parent valued the assets of the subsidiary and they found there is fair value adjustments of some non-current assets. If there is any fair value adjustment, it gives rise to depreciation undercharge. Depreciation undercharge is an expense. Expenses reduces profits. So if there is any expenses reduce profits, expenses reduce profits. Now, if there is any, I'm right. Expenses reduce profits. So if there is any depreciation that was undercharged, depreciation that was undercharged, it reduces profits. Less depreciation undercharge on fair value adjustment. So if there is any depreciation undercharge, it reduces profits. Now, there can also be depreciation, and these are where most marks in consolidation are earned. Depreciation over charge. And this one normally arises on sale of non-current assets. On sale of non-current assets, and only this arises if it is the parent to subsidiary. If it is the parent who sold assets to subsidiary. So if parent sells to subsidiary, you add depreciation overcharge. I will explain it when I'm covering an example. Don't worry about that. Next, if there is any it is only that. So that is what we need there. Next, you get you add that total. The answer you get there is called adjusted retained earnings. Adjusted retained earnings of subsidiary.
Excuse me.
Adjusted, yes.
Does not impairment appear also in the adjustment of retained earning?
Pardon? Repeat your question.
I wanted to understand if retained earning does not also affect the adjustment of retained earning. I mean impairment.
I'm coming to it. I've not completed the statement.
Okay, thank you.
I've only been working on adjustments that affect the subsidiary. I've not still come to adjustments that affect the parent. Are we together?
Okay, yes, we are together.
I'm just going step by step so that I don't confuse. What have I been working on? Adjustments that affect the subsidiary. If I put all of them, you will get mixed, especially here. If I put all of them at the same time. So I started with adjustments that affect the profit of the subsidiary, not the parent. Okay? And then you come and get percent, okay? What have I done there? And then you come and less. What do you less? Pre-acquisition retained earnings of subsidiary. You come and less it there. You less it, so I'll put it as a less it. What you get is post-acquisition retained earnings of subsidiary. Post-acquisition retained earnings of the subsidiary. And then you now get the percentage of post-acquisition retained earnings of subsidiary. So it will be a percentage of course you acquired percentage of B. So let me call this value A adjusted. Where is the adjusted? Let me call this adjusted value A, and this one, let me call it value B. So it will be a percentage of B. You bring it there. You bring this amount here, but only the percentage acquired. And then now next, you make adjustments that affect the parent. You make adjustments that affect the parent. Adjustments that affect the parent. Let me reduce it slightly. Adjustments that affect the parent. What are some of the adjustments that affect the parent? That is what you want to look at. For example, you see here, it was unrealized profit on goods. But if it is the subsidiary who sells to the parent. Now, if it is a parent who sells to the subsidiary, you less it here. Less unrealized profit on sale of goods, but if it is the parent to subsidiary. If it is the parent to subsidiary, you less that there. If it is the parent to subsidiary, you less. Parent to subsidiary. Same to depreciation overcharge on sale of non-current assets. You come and add here. Depreciation overcharge on sale of non-current assets, but this is now subsidiary to parent. The other one up here was parent to subsidiary, but this one is now subsidiary to parent. If there is any asset impaired, you less impairment of goodwill. Impairment of goodwill. If there is any impairment, if goodwill has lost its value, you less any impairment of goodwill if goodwill has lost its value. Next, you add proposed dividends or just the dividends. You will find it in current liabilities. But this one, again, there is a note I will explain tomorrow. It depends on how you are asked to account for dividends. If dividends has already been accounted for, you don't account for it. But if it has not been accounted for, you account for it. I will explain it tomorrow, don't worry. You add any proposed dividends. And many more adjustments, but the others, and then now you get the total of these. Don't forget, when you are getting this total, remember also to add these, the amount of the parent, everything in that column. So the answer you get is what gives you consolidated retained earnings. So if you see a balance sheet question with 30 marks, you know there are a lot of adjustments to be done in the retained earnings. And you must know all the adjustment. Please, let's minimize questions there so that I'm in a position to do an example. So when I'm doing an example, you will ask all your questions. So non-controlling interest is working 3. Now, in working 3 again, non-controlling interest, there are 2 methods of calculating it. There are 2 methods. So let me read what is here so that I correct it. NCI is expressed as a percentage of equity of the subsidiary. There is something not right there, duplicate. Okay, it's right, but that is, let me put a new slide first. There are 2 methods. That is a slide I wanted to add first before I read that. There are 2 methods of calculating the NCI. There are 2 methods of calculating NCI. Method 1, you now are used to it, net assets method. And method 2, I'll call it fair value method. Most of the exams questions ask you on the fair value method. So let's start with method 1. Method 1, net assets method of NCI using net assets. So in this case, net assets is expressed as a percentage of equity of the subsidiary. So you get it as a percentage of equity of the subsidiary. Suppose the parent acquires maybe 80%, the NCI will be 20% times the net assets of the subsidiary. So this is under method 1. This explanation is under method 1. It is explained here in this format. So it is explained here in this format. You get the net assets of the subsidiary, and then you get a percentage of the net assets. A percentage of the net assets. A percentage, you get all the net assets of the subsidiary, and then you get a percentage of the net assets of the subsidiary. That is method 1. But there is method 2. Method 2. Method 2 is called fair value method of NCI. Now, in method 2, you find the fair value of NCI at acquisition. Okay, let me just use, instead of acquisition, fair value of NCI at acquisition, you find what is the fair value, and then to it you add post acquisition profit of subsidiary, but percentage of NCI. You only take the percentage of NCI, which means there will be post-acquisition profit, but if you acquired maybe 80%, what have you not acquired? What you have not acquired is 20%. So you take 20% of acquisition, post-acquisition profits. You add it there. So the answer you get is what is called fair value.
Why do you put it in brackets while you edit?
Sorry, it's to add, not to less. Fair value of NCI. The answer you get there is what we call the fair value of NCI. Now, the next point is NCI is normally added to equity when consolidating the statement. Please let's mute. Statement of financial position. NCI is normally added to equity when consolidating statement of financial position. I'm trying to exhaust the most of the workings. Now we have looked at goodwill, we have looked at consolidated retained earnings, we have looked at NCI. Maybe finally the last that we need to look at is loan notes. Now sometimes, let me mute the person disturbing us. Sometimes the parent acquires the subsidiary, and when the parent is acquiring the subsidiary, you find that the subsidiary you are acquiring had some loan they were paying with the bank. Maybe you want to acquire the subsidiary, the owners of the subsidiary have told you to pay 100 million. They have told you to pay 100 million as purchase consideration. But you find that this subsidiary has a loan they are currently paying. And then you agree with the owners of the subsidiary that, yes, I've seen in your books, you have a loan of 10 million that you are paying. A loan of 10 million you are paying, or a loan of 20 million. Let me use 20 million. The subsidiary asked you to pay purchase consideration of 100 million, but you have found they have a loan of 20 million. So you get into an agreement with the subsidiary that, why don't I take over your loan? Why don't I acquire your loan? Why don't I take over your loan? Your loan was 20 million. Now, instead of paying you 100 million, why don't I pay you 80 million? And then the extra 20 million is used to pay what? The loan. I take over your loan. So if the purchase consideration is 100 million and the subsidiary had a loan that you are taking over of 20 million, the amount of the loan that you are taking over will reduce the purchase consideration. So if the purchase consideration was 80 million, the amount you are taking over as a loan of 20 million, it reduces the the purchase consideration of 100 million. It reduces it to 80 million. That is what I've tried to explain here. Now let's read what we have here. Suppose at the date of acquisition, the parent found out that the subsidiary had a loan with a bank. The parent will take over, in other words, acquire the loan when buying the subsidiary. The amount of the loan acquired will reduce the purchase consideration to be paid. The amount of the loan acquired will reduce the purchase consideration to be paid. The loan acquired will be written off from the state, because now the parent has taken over the loan. It should be written off. It should now be removed. The loan should be removed from the books of the subsidiary because the parent has taken it over. That is what I'm trying to say here. The loan acquired will also be written off from the statement of financial position under non-current liabilities. The loan acquired should be written off from the statement of financial position under non-current liabilities. So those are the major adjustments that I have. Now there is what we call rules before we go to an example. Rules of consolidating statement of financial position. The first rule: consolidate non-current assets, current
We can't hear you.
in my place, and I use Liquid Telecom. So whenever there is disconnection, I've just changed now the network. Now I'm trying to tether. Sorry for that. Let me. I had lost power. It is still not back, but I'm now tethering. Okay, fine. I think power got lost when I was here. So we have said for the non-current assets, current assets. Am I clear? Am I clear?
Yes,
yes.
Okay, fine. Okay, let's continue. So for the non-current assets, current assets, non-current liabilities, and current liabilities, you take the parent plus the subsidiary. You take the parent plus the subsidiary. But for equity, you only consolidate equity of the parent. Don't add the subsidiary equity. You only consolidate equity of the parent. Don't consolidate equity of the subsidiary. I will explain why later on. Now, number 3, investment in subsidiary is not consolidated. What do we mean by that? If you go to your non-current assets, you will find one non-current asset called investment in subsidiary. Don't consolidate it. Don't add it unless there are other investments. If there are other investments, only consolidate other investments. I will explain that with an example, don't worry. Positive goodwill is included in non-current assets, while negative is not included. I think that one I had already explained. Non-controlling interest is added below the equity. I had also explained that. Where do we take non-controlling interest? We are remaining with 30 minutes. Can you allow me the 30 minutes I used to explain basic consolidation without adjustments? Is that okay?
Yes, okay.
Yes.
So that tomorrow when we come, we look at a past paper question. We don't look at book examples. So allow me, especially those doing it first time, basic rules of consolidation. We look at a basic consolidation question. So if you have your notes, go to page 15. I'll pick example 2 because of time. I don't have time to cover example 1. I'm going to pick example 2 in the notes because it also covers everything in example 1. So we go to page 15 of our notes. Page 15. I'm interested in example 2 because it covers even the loans. So let's keenly follow this as we try to wind up, we solve this. So example 2, it's page 15, 16 of your notes. H Limited, a public listed company, acquired 80% of S Limited ordinary shares on 1st January 2006. There is a full stop there. H Limited paid 47 million for the acquisition when the retained earnings was 5 million. Retained earnings. In other words, this is the pre-acquisition. In other words, the time you are paying, you are acquiring, you paid 47 million when the retained earnings was 5 million. As part of the acquisition of H Limited, as part of the acquisition, H Limited acquired again 5 million loan notes. You acquired a loan of 5 million. So those are the key, I've circled the key points. Let's continue. Now, additional information. Okay, I said a question without additional information. So prepare consolidated balance sheet for H company. This example is only guiding us how to consolidate. It is this question here. Now let's quickly have our workings. And we said, if there are no additional information, the first working should be what? Goodwill. Now this question has not given you fair value. This question, I'm again repeating, has not given you fair value of non-controlling interest. Therefore, the only method you can use is net assets method. Net assets method is the only method you can use because there is no fair value. So in this method, remember we are working in thousands. We are working in thousands. I'm just trying to increase the size so that we see. Okay, so we start with purchase consideration. But there was a loan acquired, if you remember. We were supposed to be paying 47,000 or 47 million, but remember we are working in zeros, 3 zeros. That's why I've changed it to 47 minus the loan that was acquired of 5 million. Did we say that whenever you acquire a loan, the amount of loan reduces the amount you are supposed to pay? The amount of loan reduces the amount you are supposed to pay. So, what do we have here? It will be 47 minus the loan of 5,000 or 5 million. It gives you 42. And then you come to net assets. of subsidiary. Take note that I've talked of net assets of the subsidiary. You go to the equity. You go to the equity of the subsidiary. You see this H is the parent, S is the subsidiary. You go under equity. You can see this is equity. Don't pick the equity of the parent. You use of the subsidiary here, net assets of the subsidiary. So what are the net assets of the subsidiary? There is share capital, share premium, revaluation reserves, and retained earnings. So there is a share capital, there is a share premium, there is a revaluation reserves, and there is a retained earnings. But for retained earnings, use the pre-acquisition. I had already explained it in the format, pre-acquisition. So what is the share capital of the subsidiary? 22. Share premium is 10. So share capital is 22. Share premium is 10. Sorry, 10.
8.
Yes?
8 for
The
reservation.
next is 8, revaluation. Now here, please, retained earnings. Don't pick this one. Which one do you pick? Remember, this is the total. You pick the pre. Pre is normally given up here. H Limited paid 47 million for acquisition when the retained earnings of S stood at 5 million. So what is the pre-acquisition retained earnings? 5 million. So what is the total net assets? Now, if there is fair value adjustment on non-current assets, you add it there, but it is not there here. We will get a question tomorrow morning that has it. Total net assets. So what is our total net assets? We get the total here.
45.
45. And then you get percentage of total net assets. What percentage did we acquire? 80%. Times the net asset is 45. So you bring it here. It is 80% times 45. What we get is 36. And then when you get the goodwill, goodwill is equals to purchase consideration minus what? Percentage of net assets. So what will be our goodwill? 42 minus 36. It is positive. The answers turned out to be?
It is for non-current asset.
Yes, it is positive goodwill. So if it's positive, positive therefore goes to
Non-current asset.
Goes to non-current assets. So that is goodwill. Working number 2 is what? Consolidated retained
earnings.
Consolidated retained earnings. Consolidated retained earnings. So in consolidated retained earnings, you show what goes to H Limited. Remember, H Limited is the parent. And also, you show what goes to S Limited. What is S Limited? It is a subsidiary. So you show what goes to the parent and the subsidiary. And remember, we are working, lest we forget, we are working in thousands. And then we said, what do we start with? Retained earnings in statement of financial position. or textbooks call it as per the question. So what is the retained earnings in the statement of financial position? You can see it here. 18,000 and of the parent is 18, of the subsidiary is 10. Of the parent is 18,000. Of the subsidiary is 10,000. This question did not have any adjustments. So what you come, if there are no adjustments, you come unless pre-acquisition retained earnings of sub. What is the pre-acquisition retained earnings? It was given 5 million. 5 million. So you come and less it there, 5,000. So the answer you get is this minus that. Remember, this question does not have any adjustment. What you get is post-acquisition retained earnings of the sub. Post-acquisition retained earnings of the subsidiary. And then you get the percentage of post-acquisition retained earnings. So what is the percentage? We acquired 80% times post-acquisition was 5,000. This one here, 5,000. So what does that give you? It gives you 80% times the 5,000. What you get is 4,000. There was no impairment, there were no adjustments. You come and add. So what is the consolidated retained earnings? What is the consolidated retained earnings? So in our consolidated retained earnings, what you will have there is I add everything there. So what do we get? 22. So 22 is our consolidated retained earnings. We'll be interested in that figure later on. Also, that figure, we'll be interested in it later on. Let's go to working 3. Working 3 is non-controlling interest. Controlling interest. Non-controlling interest. We are using net assets method because you are not given fair value. Net assets method. Why are we using net assets? Because the question did not give you any fair value. If you are given fair value, you should have used the fair value. So net assets of subsidiary include, I'll copy these ones. Net assets, but retained earnings, you don't pick the pre. That is the only difference. So share capital is 22. You can see this, 22. Share premium is 10,000. I'm picking these values here. 8,000. And then you pick these adjusted. This one, 10,000. It's still the same. 10,000. I will explain it when there are adjustments. So what is the total? Total what? Net assets. The total net assets become 50,000. So non-controlling interest is therefore equals to 20% times the total, which is equals to 20% times the total, which gives you 10,000. Again, we'll be interested in that. Having done that, now the next thing is to consolidate. So you will come and have H group consolidated statement of financial position.
Those are working you have done.
Yes, those are workings, yes. Which workings have I done? I've done working on goodwill. I've done working on consolidated retained earnings. I've done working on, when you see W, that is working. I've done working on non-controlling interest. Now I'm coming to consolidate. H group consolidated statement of financial position as at, what was the date? 31st December 2006. 31st December 2006. Everyone should be knowing the format of the balance sheet now here. So I'll work with, we are working in thousands. I'll start with non-current. Non-current assets. So I'll find, please, let's mute. We are remaining with very few minutes, and I don't even want to extend with a single minute because I must go to the university. I have another class at 1. So non-current assets, you start with PPE. You can see non-current asset PPE there. PPE. Please let's mute so that we don't interfere with me. You take PPE of the parent is 44,500, of the subsidiary is 52,200. 44,500. Oh, I'm remaining with few minutes and some people are disturbing. Who is that now? Okay, so PPE is 44,500 plus 52,200. So look at what I'm doing there. 40 is equals to, you can see here 44 plus 52. So, but always show your workings. 44,500 plus, you must always show it in brackets. Plus 52,200. Always show in bracket 52, so that the examiner can follow what you have done. So always put it that you calculated it that way. Okay, next one is, what is our next asset? Development. Development. Development, what are we adding? Okay, let me get it first. So the development is equals to 4,000 plus 6,800. So 4,000 plus 6,800. Okay. Now, please, the first rule applies here. Investment in subsidiary, we said, is not what? Consolidated. It is always investment in S Limited. Don't consolidate investment in subsidiary. What you consolidate is other investments. Don't consolidate investment in subsidiary. What we consolidate is other investment. So investments, the one we consolidate is other. Don't consolidate investment in subsidiary. That is a rule, because there is goodwill. Because that investment is already accounted for it. We have already accounted for it when we are calculating goodwill. So if you consolidate these and then again you consolidate goodwill, you'll be double accounting, and you'll be accounting for it twice. So we have accounted for that. Other investments. What are our other investments? 24,500 plus 4,000. 24,500 plus 4,000 gives you 28. And then there is goodwill. Don't forget about goodwill. It is your working one. So we said goodwill is treated as an non-current asset. if it is positive. So we have added that goodwill there. So what is our total non-current assets? So our total non-current assets become 142,000. Our total non-current assets become 142,000. And then we go to current assets. So we find our current assets. Current assets, you consolidate as if you own everything unless there were adjustments. Inventory, receivables, and bank. Inventory, and bank. Inventory, receivables, and bank. So, of course, you know that current assets always comes in this inner column. Non-current assets, outside column. Current assets, inside. Equity, outside. Non-current liabilities, inside. Current liabilities, inside. That is format according to what we call IAS1. IAS1 talks of presentation of preparation and presentation of financial statements. That is format according to IAS1. I will explain it when we reach company accounts. Plus that. So, what mistake have I done? So we have that. Receivables. I'll also go and pick receivables. 32 plus 4,000. We have it there. Bank. Bank is 4,000 plus 3,500. It gives us 7,500. Now note, please note this. According to IAS1, you don't write total current assets here. You come and put it besides this value here. So you'll take that plus that plus that. So this total here, you don't write it down here according to format of IAS1. The total current assets comes against the last figure there. So the total current assets, and then so this gives you total assets. Total assets, it is 142 plus 6,500. It gives you 202. We next go to equity and liabilities. Equity and we start with equity. Our equity is, we had share capital. There was share premium. What else? There was revaluation.
Surplus.
Surplus or reserve. Whatever was used is what you use there. And then there is consolidated, retained earnings, which is working 2. And then you can add immediately none, or you can get the total and then you add it separately. Non-controlling interest, working, or you can add it separately. The standard is flexible. There is a standard called IFRS 3. IFRS 3 tells you you can either get this total once you have got it, is when you add non-controlling interest, or you can combine it there. So this one gives you, we said what was the rule? You only pick equity of the parent. Only pick equity of the parent. Don't add the two. Only pick equity of the parent. Only pick equity of the parent. Only equity of the parent. And then consolidated retained earnings was working 2. And non-controlling interest was working 3. Okay, I'm almost there. So what is the total? Oh, sorry, I put them in the wrong column. It's supposed to be in this last column. Just allow me to redo it because I must follow the standard. So share capital is that. Okay. Consolidated retained earnings is 22. Non-controlling interest is 10. So this is called total equity and non-controlling interest. So if you combine non-controlling interest in it, you call it total equity and non-controlling interest. Total equity and non-controlling interest. So that gives you 104. And then we go to non-current liabilities. And current liabilities, how many did we have? Loan, 10% loan notes and deferred tax. 10% loan notes and deferred tax. So remember loan notes, look at here. There is a loan of 25 bar and there is a loan of 8. I want to explain something there. Look at what I'm doing there in bracket. 25 here, 25,000 plus 8,000, and then you remove 5,000. Why do we remove 5,000? It is that loan that was acquired. You remember the loan that was acquired? The one that reduced the purchase consideration. You remove it because the parent has already acquired it. You remove the loan that was acquired. You remove the loan that was acquired. So 25 plus 8 minus the loan that was acquired, 5,000. Deferred tax. Once we cover the standard IS 12, you will know what deferred tax is. Deferred tax, 5,000 plus 2,000. So it gives you 5,000 plus 2,000. It gives you that. So what is the total? Actually, non-current liabilities, you also need just to get is plus that. It gives you 35. And then you finally go to current liabilities. Current liabilities. Which current liabilities do we have? Current liabilities, accounts payables, taxation, and bank overdraft. Accounts payables, taxation, and bank OD, bank overdraft. So what is our accounts payables? 26,000 plus 9,000. 26,000. 26,000 plus 9,000. So 26,000 plus 9,000. Taxation is 22,000 plus 4,000. 22,500. 22,500 plus 4,000. And finally, bank overdraft is 0 plus 2,000. So we just pick that one then. Okay, so what we get is total current liabilities is that plus that plus that. So this is 0 plus 2,000. 0 plus 2,000. Now, finally, what we get here is total equity and liabilities. Total equity and liabilities. So we talk our total equity plus non-current liabilities plus current liabilities. What do you get? 200 and 2,000, 200 and 2,500. Has it balanced?
Yes.
You can see that it has balanced. And that is how we prepare consolidated statement of financial position. I've taken 1 extra minute. I promise you tomorrow I'll release you 1 minute earlier to compensate. So let's stop there. I'll share these. Please try tomorrow and come at least 15 minutes early so that you review this question we have done. Because tomorrow when I come, I'll go straight away to a past paper question. Are we together? I'm going to share this immediately. So tomorrow when you come, revise it today or tomorrow. At least 15 minutes, review this question so that tomorrow when we come, we straight away go to a past paper question. Are we together?
Yes.
Yes. Can I ask a question?
Yes.
At what time tomorrow?
Tomorrow the class is at 8.
But you
Can I
have
ask a question about
15 minutes
But you have what?
is it
to come
Online
15
or
minutes.
physical?
It will be physical.
Okay.
I
Yes.
have a question, sir. Yes.
Can you share this?
I'm going to share in the group. Another question?
Yes, I have a question about the goodwill. If the goodwill is negative, it will appear in income statement. But what about the investment if the goodwill appear in income statement?
What about?
The investment.
You still don't account for it. Don't account for it. It will, you see, here, look at here. You see goodwill here, if this was negative,
yes,
goodwill, you come to retained earnings here and add 6,000. You add 6,000. So which means if it was negative, if it was negative, is that okay?
Yes. Yes.
Negative 6,000. You will come here and add 6,000. So this will not be 22,000. It will be 28,000.
8. Okay.
Do you agree? Now,
Yes, I
if that
agree.
is 28,000, you will account for it. You see, this consolidated will also go to the balance sheet, but it will come here. It will come where? It will come here.
Yes.
Is that okay?
Yes, it's okay.
Okay, it will still balance. Don't worry.
Yes, okay.
Okay, let's stop there. Enjoy your lunch. Let's meet tomorrow. Please keep time. Keep time, keep time, keep time. We'll meet in a room called Ribeiro. Kayonza I saw last time was small. Is it true? The room called Kayonza was small. So tomorrow let's meet in Ribeiro. Ribeiro is opposite my office. The same 3rd floor, opposite my office.
Okay.
A room called Ribeiro, opposite my office. And only come if you know you are eligible to come. I don't want illegal students. You know what I mean? Illegal means you are not Minicofin student, you are not Office of Auditor General student, you are private student but has not paid.
Okay.
Is that clear?
Yes, clear.
Yes.
Yeah.
Okay, fine. Thank
It
you.
is clear, sir.
Let's meet tomorrow. So tomorrow, the coordinators will be there checking who has paid and who has not paid. And they'll also be having the list of Minicofin students and list of Auditor General's office.
Okay, thank you, sir, to inform
And
us.
list, of course, of private students who have paid. Okay, thank you. Let's meet tomorrow. Keep time, please.
Thank you.
Thank you.
Hope we are getting this.
Yes, you are getting it right now before I go to the university.